Hi everybody, this is Ryan Pollock with Nationwide Mortgage Bankers. It's January 6th of 2019. Making this video about reverse mortgage. Really, I wanted to talk about two types. I'm going to talk about the federally insured home equity conversion mortgage, and then also HomeSafe, which is a proprietary jumbo reverse mortgage offered by Finance of America and other investors in the reverse mortgage space. So, reverse mortgage allows someone who's over 62 years of age to access a portion of their home equity. And in the case of home equity conversion mortgage, the federally insured program, they use a couple things to determine that percentage. One, the age of the youngest applicant, and then secondly, the expected rate of interest. That determines the percentage of the max claim amount, which is your home's value up to HUD's max claim limit of $726,525. So you're establishing a percentage of that value or max claim up to that limit, and that's in the form of an open or closed lending limit. An open lending limit is a lending limit that has future advances or draw schedule, and a closed lending limit is where you have one lump sum that's paid to you at settlement, no future advances or draw. So that's the federally insured program. A couple things. You can have non-borrowing spouse. A non-borrowing spouse is someone that's not a borrower that you're married to, who either resides at the subject property at the time of the application or does not. If they reside at the subject property at the time of the application, then the non-borrowing spouse can basically file claim if the borrower passes away for a deed on the home, and they can reside in the property for the rest of their life and enjoy the same, home ownership rights. They can't access the HECM proceeds, but they can live in the house. They can sell the house, refinance the house, or leave the house to anyone they choose to leave it to. So that's the eligible non-borrowing spouse. Basically what happens is they take the age of the youngest in an eligible non-borrowing spouse situation, and that determines what the lending limit's going to be. So in other words, if you have an 18-year-old non-borrowing spouse that lives at your house at the time of application, then your lending limit's going to be based off that 18-year-old's age, and it's going to be pretty bad. If you have an ineligible non-borrowing spouse, that's a non-borrowing spouse who does not reside at the property at the time of application, then the lending limit's going to be based off of the borrower. The ineligible non-borrowing spouse has no claim to the house, has no future claim, and cannot become eligible at any point in the future. So there are a couple caveats with the home equity conversion mortgage that I wanted to point out. Also, too, you can take title in the form of fee simple. You can have a life estate, with remainderment and have future interest in your property. It can be formed in trust. So as long as the the applicants or the beneficiaries of the trust during the lifetime, or part of the application and over 62 years of age, then that's okay. And, so reverse mortgage is a really flexible product that allows you to access a portion of that equity. You can use that money in any form that you choose. It's deferrable in its repayment, meaning that you do not have to repay it while you're occupying the home, but there is no prepayment penalty. And so if you choose to make payment or would like to make your own payment schedule, you can. And in the open line of credit, if you did make repayment, you can reuse those funds again. And so that's in the federally insured HECM program. That is the open lending limit, the variable rate line of credit. So again, HUD does have a closed-end line of credit. It's a fixed rate program. It's not really utilized as much in the marketplace right now. That program allows the senior to take up to 60% of the lending limit in the first year, unless they have some sort of liens against the house or other repairs set aside required to repair the house, or a life expectancy set aside for taxes and insurance. They're called mandatory obligations. If they had those mandatory obligations that required the total use of the line of credit based on their age, then they could use the total line of credit. But otherwise, If you're free and clear in the fixed rate program with the Federal Housing Administration's HECM, then you're only going to get 60% of the available lending limit, and that's it. So, there are just a couple little features about the reverse mortgage. I know that's a lot of information. I'm about to go into a lot more as soon as I share my screen with you. But that's what this is about, being transparent, explaining the product in detail. You can rewind it, go back, so that you can learn as much as you can about reverse mortgage, because it's a big decision, but it is a really good product. It is flexible, really not as bad as it's gotten a reputation that it probably does not deserve. From borrowing terms, it's really not a terrible program. It is a little high cost if you're just doing line of credit borrowing and you have no balance on your home now or mortgage against your home. But reverse mortgage really has its space for people who need it, and for other reasons too. But you can give Sharon, my colleague, a call. She's taken applications in Maryland, Virginia, Delaware, Pennsylvania, Georgia, Illinois, and Michigan. She'd be happy to talk to you about the reverse mortgage program that the Federal Housing Administration insures, called HECM, and also too the HomeSafe product in the states that it's available in too. So HomeSafe is that's structured pretty much across the board in most states as a closed-end reverse mortgage, meaning that you get one lump sum disbursement of your HECM proceeds. The requirement really for HomeSafe is that you did not qualify for HECM, and so there is no value minimum unless it's a condominium. So if you didn't qualify for HECM, we can look at HomeSafe. HomeSafe has some flexibility as it relates to compensating factors to qualify for the program that is not available in the HECM program. So the HomeSafe program is a pretty good program. I'm going to talk about it more again in the screen share, but it's a pretty good program. There is some other programs or options for HomeSafe as far as it being an open line of credit in California, or at least on a portion of your available line of credit. So it's a pretty good program. I'm about to talk to it again a little bit more here in the screen share, so let's take a look. The following disclosure is called reverse mortgage comparison. It's a really good disclosure to highlight some of the differences between the home equity conversion mortgage insured by the Federal Housing Administration and the jumbo proprietary HomeSafe product offered by Finance of America and other investors in the marketplace. So I'm going to start with home equity conversion mortgage, and I just want to highlight a couple things about HECM and how it's structured, so we can kind of dig into the different line items one by one, so you can gain maybe a better understanding. So the Federal Housing Administration insures certain principal limits, which is principal limit factors, which is a percentage of your max claim amount that determines your principal limit. And your max claim amount is the lesser of your home's value based on an FHA appraisal, and the max claim limit, which was just increased for 2019 to $726,525. So any home value or appraised value above $726,525, you would not receive a percentage of in the form of a principal limit. So again, it's the lesser of the max claim amount or your home's appraised value, and it will always be the same max claim and home value up to this limit. So again, they determine the principal limit by a factor and percentage of the max claim amount. So they use three different things to determine that percentage. They use the age of the youngest applicant, the expected rate of interest, and again, that max claim amount. So the expected rate of interest is not the interest rate on the loan. That is the lender's margin and the 10-year swap rate. And I'll include a link in the description for the 10-year swap rate so you have an understanding of what that index is. And it is used in determining, again, that principal limit factor and percentage of your max claim amount. So the age determines the tier based on the rate for the percentage of this max claim amount, which determines your principal limit, which is the loan amount or your lending limit. So HUD insures two different types of line of credit. They offer an open line of credit and a closed line of credit. An open line of credit
is a credit line that has future advances and draw schedule and available line of credit that you can actually access. So that's an open line of credit. Most are offered in the form of an annual LIBOR and a monthly LIBOR, variable rate of interest. In this example, we're using the annual LIBOR. And you have in the first rate section here what's called the margin, and that's the lender's selected margin that's used to determine the interest rate and the expected rate of interest. So with the interest rate, they take the applicable index, in this case it's the annual LIBOR, combined with the margin, determines your rate of interest. Then you also add HECM's requirement for an ongoing annual mortgage insurance premium, which is 50 basis points or a 0.5%, to determine your total accrual rate of interest on any money that you've borrowed. In this case would be 6.013% in this year. And also your total growth rate or interest growth rate for increasing borrowing potential on any available HECM proceeds that you might have. So to give you an example for growth rate real quick, if you had a $100,000 available line of credit at the end of the first year, you would have just over $106,000 in available line of credit. So your borrowing potential is always increasing on any available HECM proceeds. So those growth rate is just borrowing potential. I don't want you to think that's some sort of investment interest gain on some sort of equities or vested money that you have. This is actually borrowing potential increase that you can draw at any time in the future up to your limits in any year for any purpose that you desire. So the HECM proceeds are not considered income and they're not considered asset. So once you determine the percentage of the max claim amount in your lending limit, then they deduct what's called mandatory obligations, which represent the cost, liens, and set-asides that might be required on the loan. So we'll go by these line items one by one. So for the HECM program in line item number one below the principal limit, you'll see initial mortgage insurance premium. That's different than your ongoing mortgage insurance. The initial mortgage insurance is a cost that's charged at closing and paid to HUD, which represents 2% of the max claim limit. So again, it's the initial mortgage insurance, it's a finance fee, and it is 2% of whatever the lesser of your home value or max claim amount. The next line item is called origination fee, and that's a fee that the lender can charge, generally between $2,500 and up to $6,000, which represents up to 2% of home value up to $400,000 and 1% of value above or max claim above, up to that cap of $6,000 for the HECM program. Your other costs are typical transaction fees you would see for a refinance or a purchase. So your credit report fee, flooded certification fee, you have, title insurance, recording fees in the county and state that your subject property resides. So, that's your other closing cost. And these are your combined cost in these line items under principal limit, which represent cost mandatory obligations, which are deducted from your lending limit to leave you with your remaining principal limit, in this case 323,301.03. Then they deduct any mortgages you might have against the property, if you do, any repair set aside. So a repair set aside would be a property that may not meet FHA's minimum property standards or requirements, and so you might have to have a set aside up to 15% of the max claim amount to be set aside for repairs to bring your property to minimum FHA standards. So they do that by putting it in an escrow bearing account or setting aside a portion of your line of credit in an escrow bearing account that would be dispersed to you upon completion of any required repair items. So once the work items were completed, an appraiser would come out for a final inspection, and then once the appraiser signs off on any applicable required repairs, then that portion of line of credit would be reopened to you. So life expectancy set aside is either a borrow elected or a lender required set aside for the payment of taxes and insurance. And so, depending on whether or not you meet the financial analysis requirements HUD has now for the federally insured reverse mortgage, will determine if you need a life expectancy set aside for the payment of your taxes and insurance. And that is where the lender would make those payments on your behalf, much like an escrow for a regular mortgage payment, where your taxes and insurance is included in that payment. But in the reverse mortgage, what happens is that set aside for life expectancy, which is based on the age of the youngest applicant, which determines the amount of months required to set aside, is set aside and is line of credit that is not available to you, so that they can take that money and disperse it to the applicable authorities. So that's the life expectancy set aside. The next column here just tells you what your total mandatory obligations were. So that's everything from your cost to your liens to your set asides. And it tells you the percentage of the principal limit that represents. And then the next line here shows you your initial disbursement limit, which tells you you can take up to $208,803.29 in year number one, as you can take 60% of your principal limit in the first year if you have no mortgage or a mortgage up to 50% of the principal limit. So you can take up to 60% in year number one. If your percentage of principal limit is over 60%, as you have a mortgage lien or mandatory obligations that require that use, then you can take an additional 10% in cash above and beyond that percentage. So for example, let's say that your mandatory obligations require that you use 65% of your principal limit in the first year. Well, then you can take an additional 10%, which represents 10% of your principal limit in the form of cash out. So your initial disbursement limit would be 75% of the principal limit. So the HECM proceeds that are available to you at closing can be dispersed in a few different ways. You can choose to have it dispersed to you over a monthly term, a term that you choose. Could be anywhere from 1 year, 5 years, 10 years, 15 years. So you would receive a monthly payment every month through that term. You can also choose what's called tenure. And tenure is where you receive a set payment for the remainder of your occupancy in the home. So that's the tenure. You can also choose a combination of lump sum and term and lump sum and tenure, meaning that you could say, I need $30,000 at closing, and the remaining line of credit is structured in the term that you select or the tenure that you select. So you can also change the plan and disbursement plan at any time as you're in the reverse mortgage with your servicer. It's normally a $20 fee to change that plan, but you could go for tenure to term, or you could decide to use it as just an open line of credit and make requests for draws at your own determination and need. And so you can make plan changes. That's no problem at all. You just contact your servicer to make that applicable change. So that's pretty much it in a nutshell for the HECM program. It's just a quick overview of how things are structured. A couple things I didn't go over real quick, or one thing I know I didn't address, was the cap on the interest rates for the annual LIBOR program. So for the annual LIBOR program, there are caps on the rate of interest. So your interest rate is 5.513%. That's the actual interest rate, not the total accrual rate. And that can increase by as much as 5%. That's called the life cap as you're occupying your home, with a cap of 10.513%. So that's if the annual index, LIBOR index, increases its cap at 10.513%. But the annual program also has annual caps too. So it can't go up by more than 2 in any year or down by more than 2 in any year. So you have your annual cap protection and your life cap protection. So that's the interest rate portion. I think we've gone through every line item here. Feel free to rewind at any point if it wasn't clear. I know it's a lot of information. So, all that being said, that's the HECM program. Again, they have the open line of credit, which is the program with future advances and available HECM proceeds. Their closed line of credit really isn't utilized very much in the marketplace now. That program is called, the fixed rate program. And the fixed rate program is a lump sum disbursement at closing. You just get one lump sum, it's a fixed rate. There is no future advances with that program. So I'm going to jump in real quick to the proprietary jumbo reverse mortgage program. You're going to notice that that's offered really right now is three different program types. You have Plus, Standard, and Save, Home Safe. The Plus is the highest lending limit available, and you'll also have the highest rate of interest for that program at 6.99%. But it gives you the highest principal limit factor of your home's value. Your Standard program is a little lower rate of interest, but also a little lower lending limit. And then your Save program, again, a little lower rate at 5.99% and a lower, principal limit as well. So, and you'll also see too that there is no origination fee for the Plus and Standard, but there is an origination fee for the lowest rate of interest in the SAVE program that's paid to Finance of America. So, outside of that, the big key differences between HomeSafe and the HECM program are that it's a fixed rate, number one. So all of the HomeSafe products, except for Select, HomeSafe Select in California, are all fixed rate programs. They have no ongoing mortgage insurance. So it's just one rate of interest. That's your total accrual rate. So you'll see that the difference between HECM and HomeSafe, total accrual rate of interest and rate of interest, is pretty close. Actually, it's lower in the SAVE program. Also, too, you'll notice that the Plus program and the HECM program principal limits are pretty darn close too. This is an example of a 75-year-old borrower, but they are pretty close across the board. There is no upfront mortgage insurance premium with HomeSafe. And in this example for Plus, there is no origination fee. And your other closing cost are again your standard closing costs for any state that you close in. And please keep in mind that the fees here were updated for the HECM. That was not carried over, but you're going to have the same general other closing cost that you would with the HECM program as well. But the costs are about a third of HECM, which is really nice because, again, you do not have that upfront mortgage insurance and no origination in most cases. So a lower cost of credit overall. And that gives you a higher remaining principal limit to pay your other mandatory obligations, and or if this would end up dropping down here, if you have no other mandatory obligations, being your available HomeSafe proceeds. And so, if so, as you see in both examples, there are no mortgages or other set-asides, the available proceeds are actually higher in HomeSafe. So the HomeSafe product's really nice right now. It has some really nice features too, and flexibility that gives us some options to approve borrowers that we could not approve in HECM. And that's really the caveat or requirement for HomeSafe approval, is that you did not qualify for the HECM program. So HomeSafe is not offered in every state. We will list the states in the description of this video that HomeSafe is now offered in. In our immediate area, Pennsylvania is one of those states. So if you were denied for HECM for any reason and you're watching this video, give us a call. Let's see if you qualify for HomeSafe, because you can use it for values less than this max claim limit for HECM here, as long as you did not qualify for HECM again. So that's the HomeSafe product, and it's three different forms: Plus, Standard, and Save. Your other product selections are in California, Florida, and Texas for what's called their Flex program. And Flex just gives you the ability to take up to 40% of your principal limit and take that in the form of a 1 to 5 year term. So you can have that paid out to you over a 1 to 5 year term, your HomeSafe proceeds. That's called Flex. Again, it's only available in a few states. HomeSafe Select is an actual open line of credit jumbo, just offered in the marketplace here recently, I think it's only in California at this time. I haven't seen any updates to the contrary. But interesting program. This isn't a true representation here because there is an actual growth rate with Home Safe Select. It's based off of the requirement that you take 25% of your principal limit at closing. So you have to take 25% of the principal limit at settlement. The remaining 75% of your principal limit would be a true open line of credit. So you would have future draws that you can take, et cetera. And you would also have a 5% growth rate on that 75% of the principal limit, which is considered your open line of credit. So it's structured a little different than HECM, but still does have growth rate and still does have future draw advance and is an open line of credit on 75% of that principal limit. But same thing here, you'll see that you have your margin, your interest rate. They don't have ongoing annual mortgage insurance, so the expected rate of interest matches your interest rate in this case to determine your principal limit. And that is Finance of America's limits determined by the age of the youngest applicant and the value of your home and the interest rate on the Home Safe selection. So really good product, fantastic. Home Safe Select does have an origination fee, as you see. It's capped at $8,000. And then you have your standard other closing costs as well, but still a lower cost product overall than what you'll generally see with HECM because of that initial mortgage insurance requirement. No ongoing mortgage insurance added to the rate of interest, and very good lending limits that are very close to HECM offerings right now. So it's a really good product. I'm excited about that product and hope that it's offered in other states soon here. So outside of that, that's just the structure of HECM. I wanted to go to the screen so we could go through it. I hope the information was informative. And now let's get back to our regularly scheduled programming.